everyone. Thank you all for joining, making time for, well, this is such a distinguished panel. So I think we all just made introductions, and I think, frankly, most of these people do not need introductions. Thank you again for supporting. I'm Will. I'll be moderating, and the topic of this discussion is really about what is the challenge around bridging traditional or institutional capital to the crypto ecosystem. Everyone here has an interesting blend of experience. I know a lot of people are used to seeing talks more catered towards two ends of the spectrum. It could be very consumer driven, it could be very marketing driven. And then the other side is, well, purely investing. But ultimately, in order for crypto businesses to really scale, you have to find that bridge. And to be able to speak the languages across these different, frankly, universes. Again, these people here are the experts in that. So thank you again for joining. So, icebreaker. Describe today's crypto market as a type of food.
I guess I'll start. I guess if you know those like bags of jelly beans where they have a wide standard deviation of different flavors, some borderline offensive, some amazing, I would say that the industry is very, very similar to that, because one day you happen to get that product market fit, similar to like when we think of like stablecoin, and others is more like an opportunistic fly by night kind of reactive type of approach. Or you see an opportunity set that you think is very, very attractive, yet when you dig a little bit deeper, they realize that the market's just not there yet in terms of application. So I think it's a daily fluctuation of emotions that you experience within this industry.
Mustafa?
Well, thank you very much for inviting me here. I think oysters, because they can be either really, really good or really bad. And sometimes you get the hype from a restaurant, but you end up, in the hospital the next day. So yeah, oysters.
That's my favorite food, by the way.
Just make sure you don't eat it from a street. So.
I'm going to say kaiten sushi, the conveyor belt sushi, because, crypto markets are very cyclical also. What goes around comes around. Variety, lots of different narratives, lots of different, levels of hype versus substance. It's a completely, it's always surprising, right? Sometimes you find things that you did not expect. So, and also one of my favorite things to eat. So,
okay, I could use the AI answer, which is pizza. I'm not using that, but I cheat. I choose a beverage. I would choose champagne, because some of it you use to play, some of it you use to mix, some of it you drink, and some of it you keep.
Great answers, everyone. And one of the reasons why we wanted to ask this as an icebreaker is, again, when it comes to bridging between these different worlds, oftentimes it just feels like you're speaking completely different languages. Nowadays, like I come from a more TradFi background. A lot of my old friends who are either in banking or private equity, they have no idea what we're talking about when we say layer one. Like, what is bridging? Like, how do I farm? Right. So I find that these analogies are super helpful to visualize, like, and put it in the simplest terms, so you can cut through a lot of the noise, a lot of the jargon. So, continuing on, for the most established projects, I think right now is that you've built history. You've shown that you have staying power. Your teams are strong. Your tokens have stability. Next step is really scale. How do you attract the institutional capital? How do you show them that you are worth investing in as a business, while also maintaining that decentralized ethos, the crypto ethos? I think it's often a struggle, but I'd love to hear more from your guys' perspective on this. Solomon?
Yeah, so I don't think they're not mutually exclusive. I really do think that, just similar to like when you deal with an asset manager that has multiple different strategies that execute, I view the foundation as very similar. For example, at our foundation, from a treasury perspective, we have a gentleman named Michael Ching, who was executive from the Bank of Hawaii. And he's also based in Hawaii, so he's the time zone doesn't do us any favors. But he looks at a large portion of our treasury from more of an institutional angle, naturally. And then we have our head of ecosystem, who has a background. His name's Ash. He has a background in more growth, go to market from YouTube, Spotify. When he actually communicates to our investors, he's in our community, he looks at it more from just traditional growth metrics. And so when we talk to any particular investor or anyone in the community, we typically overlay, a lot of the traditional, what is going to be the return on the investment? What does the IRR look like? All the standard things that we're used to. My background is very much traditional finance as well, with kind of the growth metrics that tend to be very blockchain native. And a lot of the KPIs, whether it be stablecoin volume, TVL, from an RWA perspective, assets on chain. So we typically overlay these two. And then in terms of making sure that it resonates with either audience, we may emphasize one or the other.
Yeah, I mean, I think there's this perceived tension between the institutional and community side of things, but I actually think this is just a symptom of, failure in the design. And I think a really good way of thinking about this is if you think about the city. And what I mean by that is the core rules for the protocol, which is basically the laws of physics for the protocol, whether it's how transactions are being processed, how fees work, those should be set in stone. They should not change. And this is very much akin to roads and traffic lights, basically. And it should be, fair and equitable and predictable, whether you are a large institution or you are an independent artist on the blockchain. And what that actually does, it gives the institutions the predictability that they need, that the rules won't change on a whim. On the other side, from a community perspective, you can think of them as a city planner. They decide on, where to fund the next school, the next business, the next park, but they're not particularly voting on the law of gravity. And what that really gives them is the true ownership over the ecosystem growth and direction, which, in my opinion, is the most important role that they play.
Yeah, I want to add that as technologies are apolitical, right? The blockchain is a utility at the end of the day, and that it does come with a history. It comes with a culture, but I think we can also separate that culture from the technology itself. So it also depends on what kind of application you're trying to build on top, right? So you could really support any community-based, community-focused Web3 native application. But when you start going into a more of a regulated realm, then you have to kind of play by the rules, right? So with Hedera, we've kind of come in between both worlds. We're permissioned but public, so they have some transparency in terms of who's operating the network, and that's been helpful on the regulated side of things. But we also serve the other end of the spectrum, the more Web3 native, and I understand there's always like perceptions and things that we have to clarify, right? No, we're not just enterprise chain, but it's at the end of the day, I think what should really matter the most is, is the technology up to speed? Is it fit for the purpose? Maybe without worrying so much about, hey, are you true to whatever ethos was behind Bitcoin or something, right? Maybe a little bit more of a candid take there.
So it's very practical, and I wanted to expand on that. I frankly think that if a chain is able to appeal to a wider audience, that, and you talk about it's about being apolitical. It's about delivering what is valuable to the community. And sometimes you need to be able to cater to different stakeholders in order to achieve that. I think from an institutional perspective, that makes total sense. Do you find it hard to communicate that to the broader audience, the community side of that? Because I think ultimately, if they understood, well, it becomes a very clear edge. Whoever can understand that this is the business that knows how to connect with all these different stakeholders and achieve what we want, I think, to me, I would be happy to invest. But I'm curious from the community side, do you see that kind of response? Happy for anybody to answer.
Well, maybe I start. I think Cardano is ideal to answer that because we have a fully decentralized, community-driven ecosystem, meaning even though we have a foundation, we are not the one that built it, the one that is managing the treasury. It's fully done on-chain by the community. So hence you have exactly that, I wouldn't call it a dilemma. it's more a luxury situation, is that the community actually decides how to spend the money coming from the treasury. But at the same time, they also need to be cautious on deciding on how to spend it and how fast. Because ideally, you replenish the treasury with certain incoming transactions. Therefore, you need to have a diversity and sustainable setup in order to manage that. And I think that's where the key element is. It cannot be on short, medium, maybe sometimes medium, but the decisions need to be well balanced in order to keep that balance well established. And I think that that's really the key case. And I think that's at the end what the investors will look for as well.
One other thing that at least at Aptos we really focus on is diversification of products that give you exposure to Aptos and what we have going on from a token perspective. So whether that's exchange traded products or whether that's ETFs or now the latest craze, digital asset treasuries, any of these, of course, disseminate information because they're all public vehicles. And so if any investor from an institutional perspective is used to getting that type of information, we want to make sure that it's readily accessible through these kind of indirect exposure to Aptos. And then, of course, from a retail perspective, they can also do the same if they don't want to deal with the UX UI of like Web3 because maybe they're less familiar with it, but then also they can, of course, interact directly from a Web3 perspective. So we try to give as many entry points, if you will, and as many different types of information disseminated depending on the demographic of investor.
Actually, that's a perfect segue. Wanted to ask a bit more about how you think about investing in the ecosystem. Like every chain provides different products to a wide range of whether it be investors or retail community, et cetera. At the end of the day, when you decide to invest in one application, you don't invest in another. There's trade-offs. So how does that align with your strategy? So, long story short, I guess my question is, what do you think right now are the types of projects that you as a chain should invest in, should incubate, that will have the best impact on your ecosystem?
Yeah, I mean, it's a great question. So, I mean, at the end of the day, you kind of, while we think about the importance of the infrastructure itself, it's not a matter of building a highway and just expecting, you know, a great city will appear at the end. You always have to look for that killer app. And I think that, and you obviously think about from an infrastructure perspective, what features do you need to build that others are not able to provide for that specific killer app? Now that killer app can actually be different things, and it means different things for different types of investors. So if you are thinking about pure DeFi or versus gaming versus actual institutional applications, you have to think in the context of what they need. I personally continue to think from an institutional perspective, and just by background, I just came to Mysten Labs and the Sui blockchain from Goldman Sachs, and I was running the digital assets desk there. I think treasuries will continue to be one of the key things. Money market funds and treasuries tokenization will continue to be one of the most critical things to tokenize and to bring to the community, because in reality, while we've seen a few projects that have happened in that space, the true utility of these instruments haven't been truly unlocked. And that's really what you want to get. So in my opinion, from an institutional use cases perspective, those are the things that are going to continue to take a, you know, the stage for tokenization in the short term.
So to give a very simple framework, there's really two things. Is one is what's going to drive adoption, and two, what's holding things up from those applications, right? And by this I mean all the infrastructure and like integrations that are needed. So it could be very boring stuff. Your wallet tech, your custodians, bridges, all of those things that will kind of allow you to plug into an existing ecosystem or existing building blocks. So it's definitely a big part of what we do to support. And it doesn't show you know, an impact on the TVL like from day one, but it's important and it needs to be there so that others can build. Second, I think I'm gonna echo what you just said. I'm focused on the fintech and payment space. So it's been these past few years, it's been really stable coins, and not just the issuance now, but going into the interface between stablecoins and TradFi. So that boring middleware going into the core banking systems, like that's needed, for example, and not necessarily top of mind for like the typical Web3 investor, but as we're seeing more and more adoption beyond the Web3 world and like now financial institution driven issuance, like this kind of stuff is very important. RWA is obviously been, I don't think it's a narrative, I think it's an actual real trend. And so, of course, everything that's, as you mentioned, that's a collateral grade for stable coins or your T-bills, your money market funds, that's kind of feeding into stable coins, and then stable coins themselves also feeding into RWAs, because then you have the DVP that's possible. So I was seeing those two legs really being very, very critical for all the fintech space on chain. And that's really going to be the flywheel that brings in the capital markets on chain, in my opinion. So I think that's going to be very, very fundamental and not necessarily narrative driven. So that's where I'm putting my bets on mainly.
I love the term flywheel. It's ultimately it needs to sustain itself.
Maybe to add, I think I believe, and just to repeating a bit the narrative from before with the roads, I see the different blockchains more like different cars. And I strongly believe that there is a world for multiple blockchains, and everyone has its strengths on a specific area. Cardano might not be the one that is the fastest these days. I mean, my colleagues are promoting way faster blockchains, but we have other assets that we can bring to the table. And I would believe that the part that we should focus on is interoperability. And I think really making sure that we have the bridges, that we can run the strengths of the individual blockchains and profit from it as an investor and have the respective projects reflected.
I guess I'll keep it paraphrased, but just to answer your question, where at least from Aptos perspective, we're really trying to create this on-chain economy. So it starts off with, in our view, with just infrastructure. So if it's a regulated product, we want to have, qualified custodians, we want to have broker-dealer connectivity, all that, and that tends to be very regional specific. So it's more of a coverage game. And then same with wallets, connectivity, and so forth. And then from there, we also look at basically applications. And that just, of course, is a huge set of opportunities. And then also product diversification. So like if we go back to RWAs, for example, whether it's money market funds, private credit, public equity exposure, commodities on chain, any of those, we of course want diversification on chain. As more capital comes on chain, it needs to have places to go, whether for yield or just for diversification of, from a portfolio perspective. And then also distribution, capital formation. Someone is, bringing a product on chain or bringing a project on chain, we want them to be able to build in our environment and be able to raise capital. So that's really kind of the different areas that we're focused on.
Thanks so much, everyone. I think we're approaching the end of the panel, so I'll give you a final question. I think everyone here is trying to cater to a more institutional audience. I think we're also seeing that it's the challenges are rather different compared to consumer. I wonder, is there a way for us to fast track this? Can we accelerate the growth to drive more institutional capital adoption for in our space? Right now, there's a lot of products being launched that are trying to capture that. But it seems like we're not quite taking off yet. There's some things that are missing. Would love to hear what you guys think are the cool pieces that are essential for institutional capital to come on, and how quickly can we achieve that?
I guess I can start. Of course, very tough question, right? But I think one is when I look at any institution that's actually approached us to actually leverage technology, it's either one, they want to actually grow market share, they want to grow distribution, they see the capital formation that's happening on chain, they want to be able to tap into that either with their existing products or with new products. Two, they're either looking for some kind of back office savings. That's been not experienced as much as of now. Mostly it's created some duplication because they tend to be very much attached to their legacy systems. But that over time, we expect that to be the case as well. And then there's, of course, the utility feature. So they already offer a product and they're like, okay, well, if I put it on chain, maybe it'll bring in either enhanced yield or be able to use it in more of the DeFi capacity if it's regulatory kosher. So I think if we're able to solve for any of those buckets or a collection of those buckets, that's going to be what at least acts as a catalyst for institutional adoption.
Sounds like solving for a lot of the pain points for these institutions.
Yeah, we really refer to, at least at Aptos, as like real world applications. Right now, aside from maybe like stablecoin, there's a lot of things that are happening within Web3 are, solution and search for a problem. So we really are looking for product market fits.
Yeah, I mean, I think I agree with everything that you said, but there's another kind of part of thinking about the institutional capital. So you have to actually kind of put yourself in the shoes of an institution that is making an investment in one of these ecosystems. Number one, they need some sort of a vehicle that is familiar to them so that they actually understand their rights, their claims on cash flows in the future. And that is really very difficult when you are using instruments that are not familiar and they are not kind of legally tested from a regulatory framework perspective. So doing something, for example, like having warrants, equity-like warrants, where the investors can actually invest and they know that they have rights to the token in the future, is a much better approach than doing something like a SAFT, which is not kind of very well tested from a legal perspective. That's one item. The other item is really when you talk to the financial institutions, it is really important to speak in the same language that they are used to. So there can't be things like, we are adding strategic value by investing this money. It has to be translated into some financial metrics so that they actually understand what is the net benefit. Are you de-risking the system? Are you actually increasing the potential for financial returns for everyone that is in that ecosystem? And I think the third part, also how you ask for money from those investors, is very critical, because you don't go to a construction financier and ask them to write 100% upfront check for a skyscraper to build it. That just doesn't work. And patient capital actually becomes impatient when it's flying blind. So you really kind of need to take the approach of the venture capital, structure or construction project structure, where you actually structure those capital releases into tranches so that there is a milestone and you can tie that to a milestone so that investors know what they are investing in and they know what, the proof-based capital release look like. So you have a tranche 1, for example, releases when you hit the mainnet. Tranche 2 releases when you hit 100,000 transactions per second. Tranche 3, when you optimize on storage so that there's more applications that can be unlocked. And that's the mentality. When you start speaking that language, it makes it very familiar for the institution so that they understand how to think about the cash flows, how to think about how the money is being used. All of these things are very, very important. Regardless of how good the blockchain could be, institutions will be hesitant if they can't actually measure that success.
That sounds like the next innovation in crypto financing.
Yeah, and we need to create that paradigm, which should fit into what has been, again, battle tested for hundreds of years.
Thank you.
Yeah, I like the idea of having like very, very defined metrics there. I guess it's a very broad question, right? It could be about how institutions are actually starting to play in the game themselves, issuing versus investors that are not crypto native looking to invest in tokenized assets or tokens. And so I think if you go from one angle to the other, the answer could be very different. In terms of the non-crypto native investors investing in the ecosystem, a lot of it is familiarity. There's a lot of education that still needs to happen. And I think they, for example, take a family office that does a lot of real estate and a lot of other things, but has never touched crypto. They will probably start with maybe a little bit of exposure into like a BTC or an ETF or something very simple, and then kind of work from there. I think a lot of the Web3 projects are a little bit, they're just too difficult to understand for someone who's outside of the industry. And so it's probably just easier to invest in a well-known crypto fund, for example. And like you have a track record and you're like, okay, you just leave it to the experts to figure out what tomorrow's winner is going to look like. So, I mean, I think there's a lot of options there, right? If you're just kind of an LP shopping around, you can really have your pick of crypto focused funds, but now you also have all these other options, like you have ETFs and you have DATs and so on and so forth, and then you can also play with liquid markets as well.
You raise a great point. Within institutions, it's a very broad term. Within that, you have your prop trading firms, usually the first movers. You have your large asset managers, various different funds, all these different requirements. You have your family offices, all with different risk appetites. These are all different, essentially, customers. Right? So figuring out which space you want to play in, which is your target market, and catering it, that's crucial. Please.
Yeah, I think I don't have much to add to my colleagues. I fully agree. And the other point, or the only point to highlight, is really the token utility. I mean, everybody is launching tokens to raise money, but at the end of the day, I think true investing comes with the utility. And I think that's where RWA come into place. Yeah, I think that's really bringing then the longevity around it.
Longevity. I think that's one of the best words to leave us with. In crypto, this space tends to feel short-term oriented, but the fact that we have these seasoned professionals here who are focused on building and scaling long-term businesses in crypto, again, it's about longevity. So, thanks so much, everyone.
Thank you.